Hi, man. Can we please stop selling stocks? And I'm not talking about the NASDAQ. Today was the worst day in like 2 years. But that's not what I'm talking about. Why you think I'm in the gym, bro? Well, you know why I'm in the gym? Because we need to have a long-term workout. Okay, we got to talk about what's going on. We need to talk about why you never sell. Do you see this? Man, stop playing with me, Chad. Okay, you see this, right? I hope you see it. There's actually some other nasty things in this. Here, I'll show you here. That's already sounded weird, but we need to talk about the long term. I'm just getting you a weird intro. Look at this. Can y'all see how nasty? Oh, that's, I don't know if you saw it, bro. But listen, small good decisions. Stop selling the long term unless you have a plan. And these 3 things that I'm going to show you it'll change your life. So let's get it, baby.
All right, ladies and gentlemen, all jokes aside, I hope you get a good workout in today, but we need to talk about the long term. I am going to go over in normal watch list fashion what happened today, and we're going to talk a little bit about the crazy because it actually was one of the worst days for the NASDAQ in years, but we need to talk about the long term, when to sell it, and I am for real. By the end of this video, I hope I leave you with gems that you can apply for the rest of your life that will hopefully make you a lot richer. And seriously, these are the long terms. I think most of you know how they operate. If you didn't even see, it's crazy. The video we made at the beginning of the year, it was called my $150,000 dividend portfolio. Well, yeah, that's this account. This is the other small account. I think we started both of these with about $2,000. They have different size deposits, but it has been a very good journey. And with a lot of things in the market that were both good and bad and unpredictable, we were still able to emerge with a portfolio that is growing, and we are in the game. Now, here's the deal. I don't know if it was because it was a red day, but I've been getting this a lot, and it kind of makes sense. The markets, you feel a certain way. Things have moved up really fast. Some people are confident in it, some aren't. If you bought the Meta like we bought it, or you got Nvidia, you have some stocks that have made hundreds of % in a very short amount of time. A lot of reasons could factor into it, but I've heard this question a lot of people asking, when do they sell the long term, or they're trying to find 100 different ways around it to justify selling out of their long term, whether it's one position or the whole entire portfolio. Now, here's the deal. Everybody has different lives. We all have different goals. If you set out the same goal, you know, when we made our long-term, those accounts I just showed you, you know there's no question about what I'm doing with it, because even over the years on this YouTube channel, I have stuck to that plan. And once something comes in, as Warren Buffett says, act as if you cannot change your mind for 10 years. That is exactly what we have been doing. But if that wasn't your plan, hey, you may have a different goal. But if you have really stuck out to the same plan, and if you are looking for a better plan, that's where I hope this video comes in. So without any delay, hopefully you like the video. Drop your thumbs up, all of that good stuff. I don't know. Am I forgetting the intro? I'm excited. So here's the deal, Chad. 3 simple things when it comes down to selling your long term. If you want to sell out of a single stock, or you want to sell out of the whole portfolio, my friend, only sell if you know what you are going to buy next. And now here's the deal. The way that I look at it when it comes down to my long term, the one that I have that's even not on YouTube and even bigger, the ones that I show you, any of my assets that I'm telling you, I do not sell out of things unless I know what I'm going to buy. Why this is so important? This should humble you, because how many times did you think something shouldn't go up, or something shouldn't be as high as it is and should be coming down immediately? Whatever you thought was going to happen in the market, we have all been proven wrong, and like badly wrong, right? That's the deal when it comes down to the long term. You don't know what's going to happen. So this idea of not selling out until you know what you are going to buy next, this eliminates you selling because you think X is going to happen, or you think you're the smartest guy that the Lord has ever blessed with a brain. I'm telling you, in many ways, and in every sense and shape of the word, man, this will save you if you stick to it strictly. One, by not selling anything, your portfolio or a single stock, without knowing what you're going to buy. And then in the other sense, I often talk about it, man, if you're going to sell a stock from your long term, I wouldn't be putting it into another stock. If you have a plan to save and add to your portfolio, portfolio, why do you want to sell one stock to buy the other stock, especially if your plan is to grow this over the next couple of decades? I'm only looking to sell a stock if I'm going to buy another asset, if I'm going to buy a private company, if I'm going to buy real estate, if there is something out there, another investment outside of the market, if you could plan and hold strict to that where, yeah, I don't sell my long term, I don't sell this unless I know exactly where I'm going to do and invest it in a better place, then there's no reason for you to be making any sale moves. I'm telling you, I cannot stress this enough. If you follow just this rule alone, it will save your life. And even better, even at the very least, you're like, well, I don't want to, I'm only going to trade stocks, Josh, whatever. I'm not, just like if you only do this with stocks, this will even help you. Even if you're going to sell one stock to buy another, if you do not make a sale until you know exactly what you are going to buy next, this one thing can save you a lot of headache and hopefully get you a lot better returns when it is all said and done. So that's the first key. The second key, or the second rule that you need to keep in mind, oh, I want to sell this, I don't want to sell this, is very simple. Are you going to be selling for something of higher value? This is, I really hope you get this, man. You could apply this to your cars, your girlfriends, anything, bro. For real. Trade up, never down. So when it comes down to selling your long term, you want to even sell out of individual stock, and you're like, oh, I want to get rid of this, I want to do these moves. If you are not advancing your portfolio, because I don't care, you have $10,000, $50,000, $100,000, that is your long term, whether it's in stocks or real estate, Beanie Babies. I feel like I'm Neil Kashkari now. The point is, you should be going to something of higher value. You are not looking to sell out to buy something that is not only cheaper but worth less money and has less value, upside, safety, all of that good stuff. This is why it kind of even balances out with the next one. But this is something that you have heard me say a lot. I always tell you guys, if you're going to sell out your long term, it should be for real estate. Because like I'm saying, if you sell out your $100,000 long term, even the YouTube account, like legit, that account that I showed you with $21,000 in it, if you met me a 3 years ago, 3.5 years ago, and you had $500 to start, I think, and then you could save $200 a month, which is literally 10% of $24,000 a year, even all the way up to $36,000 a year, $3,600 a month, you would have $21,000 in that account right now. That is a down payment. You could turn that $21,000 into a $100,000, $200,000, $300,000 house if you're going to live in it, depending on how you move it. Or you could find other investments out there. But the point is, I'm totally okay with selling if I'm going to turn my $10,000, $20,000, $30,000, $40,000 into a bigger asset with bigger quality and of more value. If you can work your way up, that's how I do. If you want to sell a stock for another stock, you better be going from small cap to mega cap, because that's the way that I would be going about that. So if you follow this in conjunction with the other tip there, I'm telling you, this will help you out a lot. But if you are trying to decide, oh, should I sell? Well, what are you going to buy next? And then is it of more value? Are you trading up? If not, and you can't meet these criteria, you should really reconsider why you want to do those moves if none of this is adding up. So keep that in mind. And now the final thing, and this is something you've probably heard me say a lot, and I just really hope I could explain it. And this is for all the people that bought something like Meta or Nvidia. Literally, we bought Meta at $91. Some of you were buying Nvidia right besides it, bro. It's actually crazy how much that stock has moved, all of them. And you at 100%, 200%, 300%. Like, should I sell? Should I sell? Oh, I had Snapchat, I had another stock. It went up a lot, and I didn't sell it, and then it came back down. What do I do? You do what we did last time. I know it may not seem that logical at time, but why would you sell out of a winner if you got the hottest stock in the world and you made a great purchase and you make your money off the buy? Your initial purchase is so low, it offers you safety. Why would you sell when you can be broadening out? Again, if now you have big gainers and it's time to buy a house, to trade up for something bigger, you have a plan with what you're going to do with your money, by all means, sell out, do your thing. But if it's all other things failed and you're like, well, I just have this name, it's moved up a lot, I don't know, maybe I should sell out, I'm scared I'm going to lose my profit. No. What you should be doing is broadening out your portfolio. So this is something that I said a lot. What you want to do is let the winners win. And now as your portfolio grows, that one name can grow a lot for you. But if you are depositing and still saving your 10%, what you should be doing now is buying all of the other names. So if you're making a lot of money on growth, you should be buying dividends while that one name has become 50, 70% of your portfolio. All your future deposits you could put into the other safer names or the names with more value, and that could balance out your portfolio over time. And you could even spend the next 2 years just buying straight dividends while your portfolio is still more than halfway in growth and you just ride one of the hottest stocks in the world. So this is something that has gotten me to a lot of success. This is how I've rode all of my early tech stocks. Even then, you've seen it with what we've already been able to do. And I'm telling you, when you have names and it runs up and does great for you, you don't have to panic and get worried and act on fear. You build around your portfolio until it's time to harvest, and you got to give yourself ample amount of time. My period is 10 years, but in the meantime, you could broaden out and you could do all of these other things before ever having to sell. So Chad, I hope it's very simple for you. You don't sell unless you know what you're going to buy next. You only sell if you're going for something of more value and you're upgrading, and don't sell just because something has become heavily concentrated or it's up a lot or whatever it is. You don't sell if you don't need to, when you could be broadening out and now use a big gain or a big concentration to open up the doors to really diversify and get a lot of good exposure and at a good discount. So I hope that helps, baby. And shout out to all the long terms. And remember, first thing too, we got free long-term alerts. If you ever want it, or just pay attention to the YouTube channel. If you go to youtube.com/thestockmarket, that is where I am live every day. Oh, I didn't see that. Where'd it go? But let me show you. If you guys go to the channel itself, oh, that's Jerome Powell, you will see on the community tab. Man, I can't even. Okay, where is it? Is it post? I guess it's under posts. It used to say community, I think maybe because I'm logged in, but I have all of the long terms. Anytime I've added to them, I've been giving you an update here, and you could see them. We have the YouTube account, the big account, and then even Colt Sister, which is like the smallest one that I've been helping my sister out with. So, Chad, I hope that helps, but now let's get into the rest of the watch list, man, because today was weird. So I got a little recap. I'm even, I've thrown everything at you all at once. I'm not even hiding it, going little by little. So you tell me how you like this. But it really was the worst day for the NASDAQ in 2 years. And the reason why, the chip makers led a ton of downside and got absolutely murked. Once again, the heavy concentration, NVIDIA drops 5-6%. No matter what everything else does, it's going to kill things. The Russell even went down. It was pretty strong, though, so it's not like today was like, oh my gosh, it was a crash. No, you still had a lot of names going up, but there was a lot of carnage in the chip makers. One of the worst day in years in a lot of different elements for both the NASDAQ, and I think it was for the chip makers one of their worst days in years as well, but it was all down because there was a report that the Biden administration is considering its most strictest of bans on AI chips for China. It's like something that they haven't used since like the 1950s. That spooked some things, and then there was a bunch of Trump comments towards Taiwan that affected Intel, towards who's going to be Jamie Dimon. He said he'll make him the treasurer. That affected JP Morgan. Even Snapchat, Meta, they moved off of Trump's comments about not wanting to sell TikTok. But here's the deal. I'm telling you, bro, it's another day of, oh man, Donald Trump, and then the stocks and bonds make an aggressive move, and then it gets unwound the next day. And I'm telling you, yesterday, I said it's all a lot of BS. I wouldn't fall for it. It really, really feels like 2016. If you guys were trading, post it in the comments. Tell me it does not feel the same. I'm surprised because we already had Donald Trump. But once again, it feels like that environment where like, oh, Trump. And in the lead up, everybody is panicking over what will happen if Trump wins. And then right when he wins, everyone's like, oh, it's not that bad. And they move on. But once again, if there's something talked about with Trump, in his odds of winning, it's moving bonds rapidly, it's moving tech stocks, certain industries, even then Jamie Dimon, JP Morgan. It's wild of what we're seeing. So the crazy part about it, though, and why I'm blaming all of this on the politics, because all of those comments from Donald Trump and even the reaction we got, interview was almost 3 weeks ago. It was an interview with Bloomberg that they did at the end of July, or the end of June, excuse me. We're 2 weeks into July right now. So think about it. Old comments, but whenever it came out, ta-da, low volatility or low liquidity. Yeah, anyways, but that was one part of the day. The other thing, beyond just the drop and something you should look out for further, we don't have a lot of data moving forward except for the earnings, but keep in mind earnings are right around the corner, and these big moves and like a big sell-off right before you go panicking, that's what makes it so confusing. It's either this is just going to be a major pullback before the earnings rip, or we pull back heavy in anticipation of earnings, and then earnings come back and they're not good at all, and then this was just the start of a major pullback until the end of summer. So we'll see what happens, but that earnings effect is real, and don't forget about the buybacks and all of that. End of July, that is another part that you got to keep your eyes out for. But that's all that happened today. That's my quick recap. I did make a couple of plays. I sold 1/2 or 1 out of 2 of my Unity plays to make it free. We made that play like a week or two ago. Got 100% on that. Then the Pfizer's, we made that not too long ago. I sold out 80 of 100 of those contracts. Remember the ex-dividend play? And then they broke above the 30 there. That was a big deal. So got that play, got all my money back, $200 worth of free contracts for August. I sold my bond play, the ZB, $7,000 net profit. I know there's a little bit of jobs data coming up, but I think I got a pretty good amount, and I want to double dip. I think TLT could pretty much go up another, 40 cents. So I didn't want to end up losing on that trade, especially since this was around the max profit it reached even a couple days ago, and I said I'll reposition. Otherwise, I'll just have to watch. But I do think there will be a pullback at one of these days to get a double dip. So we'll see how we could rebalance into that. And then the Russell short, I closed out of it. That ended up being good. I got $5,000. $3,500 was profit. I made back the $2,000 loss from yesterday, but then I got murdered on my NQ. Excuse me, I even got the hiccups just saying that, but I am still writing that out, but I closed all of those plays, and now we're going to see, and my plan is average into the NQ. I think today was an overreaction. It's going to come up, but I still like this idea of closing the gap between the Russell and NASDAQ, so we'll see how that plays out, but otherwise, besides the options, not really writing much and made a lot of moves, and I think even then, if it's not end of this week, we'll see where next week in earnings and Powell takes us. But now, let us get into the plays. So, kind of a weird, I'm all over the place today, but yeah, I have my 3 plays here. I'm not going to hide them from you all at once. You tell me how you like this or not, but the first one, Humana and XLV, I was talking about this yesterday. I've been really liking healthcare, and again, if there literally is a real rotation, even like a rate cut rotation, history has shown how well that healthcare and some of these health providers will do, and I was just looking at Humana. Remember, we were talking about this thing even in the long term. I had a flip on it. Remember, I averaged down around like the low 300s, and then I had shares that were way higher that I was clapped on, was able to get out of that, and I was closing out some of my exposure. But dude, look at this thing. This thing's at 402. This was one of those potential like cheap long-term plays I was talking about. It's still very cheap on the year, but even when we were having that talk about the long-term, and I'm like, yo, there's all these cheap names out there, like, bro, Humana was one of them, and now you're seeing it. So it's part of any real rotation. Humana and XLV, they are going to be a part of that. So watch out for that. I have 0 exposure in it, so just giving you guys the idea. But that is play number 1. Then play number 2, I really like this one, but Snap in Meta. I really like Meta a lot for earnings. I've been saying that before any of this happened, and now this Trump stuff, literally Trump saying he doesn't want to sell TikTok, killed Snap in Meta. I think Snap got murdered even way more off of this, and just sadly, I think all of this is just creating more wiggle room ahead of the earnings. So I do think there's going to be a short-term play. I want to wait because I've still got that NQ, and like I told you guys, I just went cash not too long ago. I'm making a couple of these earnings-related plays, but I'm trying to make them free as quick as possible. I don't want to try to manage too much. I want simple things, keep it very simple, not too much exposure, have more cash, get paid doing nothing unless it is really an absolute home run. I don't want to get suckered back into it. So taking it slow, but I like the idea of a snap play before Meta, especially if people are overreacting to Trump headlines and selling off the stock 10% in one day. So same thing goes for Meta. We'll see how that plays out. Watch out for that. That's number 2. And then finally, these 3 plays right here, man, we have all of these in the long term, and they've been killing it, but I've talked about momentum at these price levels, and I'd watch out. MO above 50, it could lead into 52, just like it broke that 47.80. You see it's knocking on the door of 50 now, so watch if it either tops out at 50, or if it can really hold above, the next level will be like 51.80 to 52. Pfizer above 30. I don't know if it actually closed there. Let's see. Oh, yeah. Wow. So you did get a Pfizer $30 close. That's huge. This does break the downtrend. Again, they got the Ozempic stuff, and their ex-dividend is right around the corner. So remember, I was telling you guys that advanced. This has some momentum. I think it could go all the way up to like 35. I think $32 will be the like next like clear level, or 33. And then other than that, I think you get like real support at like 35 to like 39.50 on Pfizer, and then Intel above $39. That opens up the recovery into 40. And then it'll probably get clapped on earnings. But all of these, I mean, Pfizer has the ex-dividend catalyst, but even then, earnings can kill both Intel and Pfizer. And then MO, I just think they're going to kill it. It's just a matter of where it wants to end after all of the movements. It's other earnings, the Zindemic, and then everything else in between. So we'll see where we go from there. But those are the main plays, riding everything else. But like I said, just pretty much in the NQ, I got my old Baidu and Roblo, and then my Intel and some of those other ones. And we're back to any of the other free option plays. But now we still got more. Oh, it's not showing up. I got really excited for that. Host countries. We still got our economic lesson here. We're going to wrap up, chapter 8, which is kind of crazy. Like I told you, almost 200 pages into this. The book is International Political Economy by Thomas Oatley. If you miss any of the lessons, we have a whole entire playlist where you can make sure you don't fall behind on any of them. But we are going to wrap up the MNCs today. And the good part is, if you think it was a little dense, this is all the setup into the politics of MNCs, which will be the next chapter. So let's get into it. We were talking about locational advantages and why MNCs chose to go and horizontally integrate or vertically integrate. And now we are on to multinational corporations and host countries. Up to this point, we have focused exclusively on what MNCs are, where they operate, and why they are established. In doing so, we have neglected the impact of MNCs on the countries that host their affiliates. We conclude the chapter by looking at this important dimension of MNC activity. FDI creates a dilemma for host countries. On the one hand, FDI has the potential to make a positive contribution to the host country's economic welfare by providing resources that are not readily available elsewhere. On the other hand, because MNC affiliates are managed by decision makers based in foreign countries, there is no guarantee that FDI will in fact make such a contribution. The politics of a host country and MNC relations, a topic we explore in the next chapter, revolves largely around government efforts to manage this dilemma. Here we look at the benefits that FDI confers on host countries in theory, as well as how few MNCs practices that can erode those benefits. MNCs can bring to host countries important resources that are not easily acquired otherwise. 3 resources are perhaps the most important. First, FDI can transfer savings from one country to another. Economic growth is dependent on investment in physical capital as well as in human capital. To invest, however, a society needs to save, and in the absence of some form of foreign investment, a society can invest only as much as it's able to save. Foreign investment allows a society to draw on the savings of the rest of the world. By doing so, the country can enjoy faster growth that would be possible if it were forced to rely solely on its domestic savings. Moreover, fixed investments, factories that are not easily removed from the country, are substantially more stable than financial capital flows, and thus do not generate the boom and bust cycles that we'll examine in chapter 14 and 15. In addition, because MNCs invest by creating domestic affiliates, direct investment does not raise host countries' external indebtedness. Of the many possible ways that savings can be transferred across borders, direct investment might be the most stable and least burdensome for the host countries. MNCs can also bring in technology and managerial experience to host countries. Because MNCs control intangible assets based on specialized knowledge, the investments they make in host countries often can lead to this knowledge being transferred to indigenous firms. In Malaysia, for example, Motorola Malaysia transferred the technology required to produce a particular type of painted circuit board to a Malaysian firm, which then developed the capacity to produce those circuit boards on its own. In the absence of this technology transfer, the indigenous firm would not have been able to produce the products. Such technology transfers can generate significant positive externalities with wider implications for development. Positive externalities arise when economic actors in the host country that are not directly involved in the transfer of technology from an MNC to a local affiliate also benefit from this transaction. If, for example, the Malaysian Motorola affiliate was able to use the tech it acquired from Motorola to produce inputs for other Malaysian firms at lower input costs than the inputs were available elsewhere, then the technology transfer would have a positive externality externality on the Malaysian economy. MNCs can also transfer managerial experience to host countries. Greater experience at managing large firms allows MNC personnel to organize production and coordinate these activities of multiple enterprises more efficiently than host country managers can. This knowledge is applied to the host country's affiliates, allowing them to operate more efficiently as well. Indigenous managers in these affiliates learn these management practices and can then apply them to indigenous firms. In this way, managerial experience is transferred from the MNC to the host country. Finally, MNCs can enable host countries to gain access to marketing networks. So hopefully you guys are getting it. It's explaining here what MNCs can offer the host countries. It's saying, one, it allows them to save faster and it brings in other people's money, and now the host countries aren't limited to whatever that they generate domestically and they could grow faster. And then it's saying you could get managerial experience and even tech that could lead to other developments that are better for the host countries. And now it's explaining here how there's marketing networks and, again, positive externalities. That's just like how it's saying if Motorola shares technology with the host country and that shared tech transfer leads into other people not even related to the industry benefiting off of it, that's a positive externality. Remember the negative externalities, and we talked about the free rider problem where everybody can access something. In this case, imagine we leave AI tech somewhere and it benefits their whole society and everybody benefits off of it and the other future entrepreneurs. That is a positive externality. So continuing, finally, MNCs can enable host countries to gain access to marketing networks. When direct investments are made as part of a global production strategy, the local affiliates of the MNC and the domestic firms that supply these affiliates become integrated into a global marketing chain. Such integration creates export opportunities that would otherwise be unavailable to indigenous producers. The Malaysian firm to which Motorola transferred the printed circuit board tech, for example, not only wound up supplying Motorola Malaysia, but it also began to supply components to 11 Motorola plants worldwide. These opportunities would not have arisen had the firm not been able to link up with Motorola Malaysia. MNCs provide these benefits at a price, however. To capture the benefits that MNCs offer, a country must be willing to allow foreign corporations to make decisions about how resources will be used in the host country. As long as foreign managers make decisions about how much capital and tech are transferred to the host country, about how the resources MNCs bring to the host country will be combined with local inputs, and about how the revenues generated by local affiliates will be used, there will be some chance that a particular investment will not enhance and may even detract from the welfare of the host country. MNCs can reduce rather than increase the amount of funds available for investment in the host country as a result of a number of different practices. MNCs sometimes borrow on the host country's capital markets instead of bringing capital from their home country. This practice crowds out domestic investment. That is, by using scarce domestic savings, the MNC prevents domestic firms from making investments. MNCs also earn rents on their products and repatriate most of those earnings. Consequently, the excess profits wind up in the MNC's home country rather than remaining in the host country where they could be used for additional investment. So if you're not getting it so far, it's saying, yeah, you can bring in a lot of good things to the host from the MNCs, but it's starting right off the bat and saying, well, yeah, there are ways that these corporations can act that actually end up hurting the host rather than helping them. And the number one thing to start off is it pulls money out of the country rather than bringing it in. And then sometimes these corporations will borrow on the countries that they're going to, and then there's already a minimal amount of savings, and then on top of it, and it's going to come up a couple of times, not only whatever else they're doing, that money gets repatriated back to wherever the home of the MNC is. So continuing, in addition, MNCs typically charge their host country affiliate licensing fees or royalties for any tech that is transferred. When the affiliates pay these fees, additional funds are transferred out of the host country to the MNC's home base. Finally, MNCs often require the local affiliate to purchase inputs from other subsidies of the same corporation. These internal transactions take place at prices that are determined by the MNC parent, a practice called transfer pricing. Because such transactions are internal to the MNC, the parent can set the prices at whatever level best suits its global strategy. When the parent overcharges an affiliate for the goods it imports from affiliates based in other countries and underprices the same affiliate exports, revenues are transferred from the local affiliate to the MNC parent. Sometimes such transfers can be very large. An investigation revealed that Colombia paid $3 billion more for pharmaceutical inputs through MNCs than it would have paid through market-based transactions. All of these practices reduce the amount of funds that are available to finance new projects in the host country. In extreme cases, MNCs might reduce the total amount of funds available for investment rather than increase them. So although it's saying it is rare where that happens, it is possible. But again, the idea here is, yeah, there's many ways MNCs can pull money into a country, but there is also many ways that they can siphon it out. Continuing, though, an MNC might also drive established host country firms out of business. Suppose the MNC enters into an industry already populated by local firms. Suppose also that the MNC controls tech or management skills that enable it to produce at a lower cost than the local firms. As the MNC affiliates local production expands, the established local firms will begin to lose sales to this new low-cost competitor. Some of these businesses will eventually fail. The failure of a local final good producer may have a secondary impact on local input suppliers. Local firms often acquire their inputs from local firms. In contrast, most MNCs source their inputs from global networks of suppliers. If the new MNC affiliate drives local firms out of business, then the demand for the inputs provided by local firms will fall. The local input suppliers will thus face serious pressure, and many of them will probably go out of business as well. Although such instances may be an example of a more efficient firm replacing less efficient competitors, the dynamic is one at which local firms are gradually replaced by foreign firms and local managers by foreign managers. If the transfer of skills and tech from foreign to local producers is one of the purported benefits of FDI, then a dynamic in which foreign firms drive local firms out of business suggests that very little technology transfer is occurring. So that's a good one. Hopefully it makes sense, but they're saying this process, whether or not it actually happens, just like think about even the theory, if big corporation drives out the business, what happens when these companies go out of business? A local company goes out of business, then the supplier that supplies that company also gets pressured. What happens? You end up replacing these suppliers and companies with foreigners, these MNCs, and then before you know it, you're all replaced and it's foreigners running your businesses in these countries, and these are the suppliers and doing all that. But if you're trying to say that, oh yeah, MNCs and foreign direct investment, it brings all of these benefits, and look, we share our technology. If you're sharing it with a foreign production manager and a foreign supplier to a foreign final goods producer in a different land, I mean, think about it. You're not really even getting a tech transfer at all. So continuing, tech transfers can be further limited by the incentives that MNCs have to maintain fairly tight control over tech and managerial positions. As we have seen, one of the principal reasons for MNC investment arises from the desire to maintain control over intangible assets. Given this desire, it is hard to understand why an MNC would make a large fixed investment in order to retain control over its technology, but then transfer that tech to host country firms. The transfer of managerial expertise also may be limited because MNCs are often reluctant to hire host country residents in the top-level managerial positions. Thus, the second purported benefits of MNCs, the transfer of tech and managerial experience, can be stymied by the very logic that causes MNCs to undertake FDI. If this happens, MNC affiliates will function like enclaves, failing to be tightly integrated into the rest of the host country economy and never realizing any spillover effects. So hopefully you're getting that one too. It's also countering all of the benefits we just went over, but they're saying, well, think about it. These companies, they cared so much about these intangible assets, and that's what caused these inefficiencies. Remember all of that, and it was so important. And then they were like, oh, we're going to build out and do all of this stuff. So they're saying, why would these corporations freely share these intangible things? And then why would the managers and all that, why are they going to teach them the managerial expertise if, again, they fought and it was important for them to hold and keep this? And they're even saying, yeah, they may teach people stuff, but they kind of keep it insulated where the high-level stuff, they're not hiring foreigners for that, so it never really has that real spillover. Mind-blowing, right? Again, that's why I love this. Going over the benefits, challenging it, it's beautiful. Finally, the decisions by MNCs about how to use revenues generated by their affiliates may bear no relationship to the host country government's economic objectives. In a world in which governments cared little about the type of economic activity that was conducted within their borders, this would be of little consequence. But when a government's use a wide variety of policy instruments to try to promote certain types of economic activity, whether it be manufacturing in a developing country or a high-tech industry in an advanced industrialized country, foreign control of these revenues can pose serious obstacles to government government policy. If, for example, a country's export earnings derive entirely from copper exports, but an MNC controls the country's copper mining operations, then decisions about how to use the country's foreign exchange earnings will be made by the MNC rather than the government. Or if the revenues generated by the local affiliate are sufficient to finance additional investment, decisions about whether this investment will be made in the host country or somewhere else. If it's in the host country, then in which sector is made by the MNC rather than by the government. In short, control by MNCs over revenues generated by their affiliates make it difficult for governments to channel resources towards the economic activities they are trying to encourage. Host countries, therefore, face a dilemma in their relationship with MNCs. On the one hand, MNCs can provide resources to host countries, including access to new sources of capital, innovative tech, managerial expertise, and market linkages that are not available elsewhere. On the other hand, because FDI extends foreign managerial control into the host country's economy, there's no guarantee that a particular investment will in fact yield the aforesaid benefits. An MNC might consume scarce local savings, replace local firms, refuse to transfer tech, and repatriate all of its earnings. The dilemma has led many to suggest that the governments may need to play an active role in structuring the conditions under which MNCs operate within their economies. As we will see in the next chapter, much of the politics of MNCs revolves around government efforts to shape these conditions in order to extract as many benefits from MNCs that they can and to minimize the cost of ceding managerial control to foreign decision makers. So, conclusion of the chapter. This is where we get to wrap it all up. Ignore this one, but here are some of the key terms I think that are good for you to know by the end of this. But continuing or conclusion, the last 30 years have been a rapid growth in the number of MNCs operating in the global economy. By 2008, the number of such corporations was 11 times the number of operation in the early 1980s. As that number has increased, the role that these firms play in global production, trade, and cross-border investment has also increased. The activities of contemporary MNCs are heavily concentrated in advanced industrialized countries. Most FDI in the global economy involves a firm based in one advanced industrialized country establishing a facility in another advanced industrialized country. Although MNCs have recently begun to shift more of their activities to the developing world, only a small number of developing countries have received substantial amounts of investment. It will take many more years of investment before the developing world's share of the MNC activities approaches the share of the advanced industrialized countries. MNCs are more than just large firms. They are firms that organize and manage their activities quite differently than traditional firms do. In particular, they have opted to remove many of their international transactions from the market and to place them within a single corporate structure. Thus, even though many firms engage in international activities, only a subset of these firms, those that have their own productive establishments in at least 2 countries, can be classified by it as an MNC. MNCs have opted to this distinctive organization structure because they face opportunities to profit from international exchange, but because they earn a substantial share of their income from intangible and specific assets that they can capture these profits on only by internalizing these associated transactions. Thus, the modern MNC has emerged as an organizational response to a specific economic problem in the global economy. Most analysts of MNC activities believe that FDI can benefit the host country as well as the investing firm. Such investments can transfer savings, tech, and managerial experience to host countries and can allow local producers to link in the global marketing networks. None of these resources are readily available to host countries, especially developing countries, unless they are willing to open themselves to MNC activity. Yet, opening a country to MNC activity does not guarantee that the benefits will be realized. MNCs are profit-making enterprises, and their activities are oriented towards that end and not towards raising the welfare of their host countries. Consequently, societies that host MNCs face a dilemma. They need to attract MNCs to capture the benefit that FDI could offer, but they also need to ensure that activities by MNCs actually deliver those benefits. As we shall see in the next chapter, most of the politics around MNCs revolve around government efforts to manage this dilemma. So, that is our lesson. All these terms underlined, make sure you know them. I think they are very, very important, but we're not done with it. And remember, when I first opened up this book, I think we started with like chapter 12 or 14. Well, when we start getting in there, you should start seeing how a lot of this stuff starts to connect. But that is just the foundation. Chapter number 8, ladies and gentlemen. But that is all I have for you. And That is your watch list, ladies and gentlemen. Make sure hydrate healthy, ready to go. Make sure post your watch list. Make sure we see you there in the morning. I need the armor on. I need the helmet shining. And I need you to remember, say what you mean what you say, baby. This will help you in business and life, and it'll help you identify what you really mean, even down to the long term, baby. But Chad, I love you. Drink that water, stay hydrated, healthy, all that good stuff. I'll see you in the morning, and on.